This week, I'm going to show you the UK stocks that I bought, as well as the top riser and faller in the portfolio, and as always, the share tip of the week, which is a high risk, very volatile growth stock listed in the UK. Furthermore, if you find this video useful or entertaining, please drop me one of these to support the channel. According to Google Finance, the FTSE 100 is up by 0.35%, and I just spat. The FTSE 250 is down by 1.46%, and the S&P 500 is up by 1.67%. My portfolio has actually underperformed this week, and don't be fooled by the total portfolio value, which is significantly higher than the week before. I'm in fact actually down by 1.62%, meaning I've underperformed all three markets or benchmarks this week. However, what I've seen is that after this vaccine news that we saw 2 to 3 weeks ago, that my holdings are actually reacting negatively upon it. That's because a lot of them are assumed to be beneficial or benefit very much from the pandemic, and I believe that many of them are wrong about it. So I've been doing a lot of buyings, hence why my cash has increased and I've deposited £575 this week, exhausting my cash position. And I'm grateful that my holdings are on a discount, especially for Black Friday and even my birthday, which oddly enough makes me 21 now, even though I still look 13. The top topics of the week start with Future PLC, which is a magazine and website publisher. They had actually announced that they were acquiring Go Compare this week, which may seem a bit odd or abstract, as it's a bit out of the spectrum of magazines and their website holdings like Glassdoor, for instance. This deal will be over £594 million, and to me it makes a lot of sense. Although a lot of investors had figured that they were going to be acquiring admiralsconfused.com, it does make sense that they have acquired Go Compare. Although this week shares of Future had dropped by 17.65%, and I understand why. Furthermore, Shadowfall, the same people that have shorted Boohoo, that were even warning about Wirecard pre the whole crisis, have also said some pretty worrying words about the business. They stated that Future is little more than a general collection of low quality, often distinct and shrinking assets. Although I feel that this is a great addition to their content library and they can use this information wisely. I will be talking about this later in the video. Arcadia, the owners of Topshop, BHS and also Debenhams, are actually on the brink of collapse, and so there's been a lot of speculation about who may purchase the business, such as Mike Ashley, which is the owner of Sports Direct, but even some retail pundits or punters, as they've been called on the media article, which is basically retail investors, us guys or girls, effectively. And what they've said is that potentially Boohoo could be making this acquisition as well, as they have a track record of acquiring businesses that are struggling and turning them around to profitability. I'm going to give my thoughts on Boohoo today and why I feel that this is a good idea for Boohoo, but also that I'm not so bothered about it. Furthermore, Boohoo had also announced their second non-executive director, actually pulling someone from retirement. This is Sir Brian Levison, and he is actually going to be monitoring the supply chain and leading the agenda for change policy, or updated in their RNS, which I had spoken about on the Twitter, which I'll leave my Twitter down there. They're going to be monitoring and overhauling the supply chain. KPMG have also been enlisted for independent monitoring of this supply chain, but don't mistake this as Boohoo replacing their auditor PwC simply because KPMG will have a conflict of interest and therefore cannot replace PwC. So we still very much need to find an auditor for Boohoo. I potentially see an opportunity, or the opportunity, that Boohoo could present if they acquire Arcadia. After all, they have some pretty valuable brands that could certainly expand their offering and therefore divide and conquer. For example, the more brands they have available, the more options, or I say options, that's what it would seem like, simply because they would have such a diverse range of brands. Therefore, customers are more likely to be drawn into Boohoo and their total holdings, and therefore it's likely that Boohoo will benefit. And knowing their history at converting struggling businesses and making them profitable, I very much feel that Boohoo could definitely turn around Arcadia, although it would require a lot of hard work because they have a very high amount of debt and some brands that just simply weren't performing that well. An example of this would have been Topshop. They hadn't really been doing that well simply because Boohoo and ASOS had really been dominating the online industries that more people had been accustomed to shopping online. Regardless, I'm excited. I look forward to seeing what may happen, although I feel that it is really speculation. Although on the other side, if Boohoo do go for this acquisition, and furthermore they've got to beat Sports Direct in the first place, if they go for this, I feel that there's going to be media backlash. This is because they could be investing this money into their supply chain. Well, that's what I feel that MPs and certain authors will likely say. I feel that Arcadia could be a good acquisition, but it requires a lot of time and money investments. And after all, some of these brands you don't really need. I know that Debenhams has a lot of baggage, for example, and I just don't really think that that's a good business. It smoothly brings me on to the top riser in the portfolio, which is also Boohoo. But this week there wasn't a top riser, but rather a stock that had dropped the least, and that was Boohoo conveniently. They only dropped by 0.92%, although closely followed was Ashted Group, which had only dropped by 0.97%. And they had done very well recently, especially with the vaccine news. Regardless, my Boohoo position is not changing. Despite this potential acquisition, I'm not going to be topping up my position, as already 50% of my portfolio is in Boohoo. I don't want to increase that significant systematic risk, especially because there are some governance issues that still need to be ironed out, and these creases do need to disappear. So I'm hoping that perhaps they'll push forward this agenda for change. If they acquire Arcadia, that is a bonus. But that doesn't mean I'm going to be buying more shares of Boohoo just because of it, because that's speculation and I'm a long-term investor that's just going to buy consistently and hold for the long term. However, one thing that didn't drop yet, including my voice crack, so my voice hasn't dropped yet, is the Discord group. We currently have nearly 100 members and not yet has anyone left. However, after this video, I suspect that would change. But if you're interested in joining our Discord community, I will leave a link in the description down below, and it's free to join. And I will be active today from 12 PM till 2 PM, so come say hi. However, the top faller in the portfolio, which I actually least expected, as it was probably my least volatile stock, is actually Halma. And it may come as a surprise to some investors, as this is a very good quality stock. I suspect, however, that this had fallen because investors had been taking profits. They thought, you know what, Halma was at all-time highs, let's take profits from this, let's buy into the value recovery plays as the vaccine news comes, as they may have more potential upside in the shorter to medium term. However, this has meant that Halma has gone all the way from the all-time highs to now below my cost basis, which I did not expect to see ever again. Another voice crack, that's 2 already. Because I feel that investors had thought that this business was pandemic proof, therefore I feel that investors, when realising or seeing the trading update, they decided that, you know what, they didn't want to leave their money with Halma anymore. And I understand why, but this was truly a resilient business that was hard hit by the pandemic. And if people want to place their money elsewhere, that provides an opportunity for the other investors that are interested. And whilst I have not topped up this position this week, I'm going to be very interested, and over the next month I may be acquiring more shares. My own position hasn't changed, it's still 25 shares, although hopefully we can substantially increase this one in the next few months. Bring me on to the stocks that I actually bought this week, and there was actually, unfortunately, a cost to this. Not only did I spend my cash position, so that's drained, on fancy special effects like those weird pop-ups you keep seeing on the left of the screen, and also I had to trim a position. This position, I just changed mood really weirdly. That just went from being like super energetic to really sad. Regardless, I'm going a bit off topic this video. I had to trim a position, and this is a company that I remain somewhat bullish on. I think that they are going to outcompete their competitors in the industry. I just feel the industry perhaps doesn't have that great of a prospect in the time being, and I feel that therefore investor sentiment is likely going to remain lower for likely the short term, so 6 or so months, and I feel that it will take multiple trading updates for the stock to increase. So therefore, this is soft cap, by the way, I hadn't mentioned that earlier, and I had trimmed 20 out of my 120 shares. I figured I'll have a lower exposure in this small time period. I'll invest that money elsewhere because there is a lot of bargains in my portfolio, not including Softcat. So I figured that capital would be best used elsewhere. And then whilst I expect these other stocks to have rallied back up, or at least recovered somewhat, I can then put that spare equity into Softcat and slowly build that one up over that short to medium term. And at the moment, since there is so much value in a lot of my stocks, even though obviously they are still very high price to earnings ratios, I feel that Softcat just isn't the one to have my money in for the time being. That doesn't mean I'm going to sell this position completely, however. I'm just going to have a reduced exposure for the time being. And if you're interested in getting a free share worth £100, when you deposit just £1, sign up to Trading 212 using my link in the description down below or the promo code at the bottom left of the video. The first stock that I bought this week is actually London Stock Exchange Group, and this is one that had fallen to a 6-month low, which I'm glad for this. This is a serious bargain in my own personal opinion, and rightly so. I've topped up. I've only bought 2 more shares, but that is quite a substantial amount considering that now brings my total to 7 shares. Sure, you could argue that a few months ago I did have 15 shares. I'm building this position up and it's at least 10% lower than when I had sold them. So I've made a little bit of a profit from trading that. I had sold those shares of London Stock Exchange Group. I'd bought into Boohoo when they were around 250 pence per share. Boohoo has gone up, and now as I'm getting spare cash flow, I'm then buying back into London Stock Exchange Group at £78 instead of £88 to £86. So I'm actually making quite a lucky trade. I don't anticipate this to ever happen again, and I think I got quite lucky with it, but it certainly turned out to be a good play that has benefited the portfolio somewhat. But this is a stock that I really don't think should be dropping. I understand that a lot of the price was held up by speculation on their Refinitiv acquisition, and yeah, this could fall through. However, people forget that this is a stock in an industry with very high barriers to entry, and what I would say is an impenetrable or nearly impenetrable moat. Think about it, when are you going to see another stock exchange pop up? And really it's only the existing competitors that are a threat, and there are usually mergers and acquisition activity going in with the stock exchanges. So I likely feel that in the future there will be limited as times go on. And I've also noticed that in my limited investment time period or time frame, I've very much noticed that stock exchanges seem to just be consistent long-term performers that aren't obviously going up like Tesla, Neo, Palantir Technologies. They're not just flying up, or meme stocks, for example, but they are consistent. They will be an excellent point in your portfolio. And when London Stock Exchange is growing their dividends by at least 15% each year, and they're not even going into the Refinitiv acquisition, which means that they could therefore give themselves another revenue stream and earnings growth potential, I think they're a fantastic bargain, and that's why I bought more shares. Whilst most people seem to be celebrating about their portfolios only going up, that some of their recovery stocks are now in the green, and honestly, feel free to celebrate. Obviously, you've been sat in the red for a long time. I would consider taking profits, but that's irrelevant to my point. I keep digressing. What I really want to say is a stock that I didn't expect to see drop is Games Workshop. And now they've dropped a significant amount. They had reached an intraday high of around £124, yet this week dropped as low as £91 per share. I saw this as a fantastic bargain for a company that has such a great management. They can place a store in any area, even a bad area, and then they will build customer traction. Not only that, but they have limited costs for their employees, such as their one employee policy. They then negotiate rent of their stores and have it so that they can get the best deals available. And then this is also a brand that is very strong. I believe they have the same, if not much more, IP, which is intellectual property, than Blizzard Activision. And they are known for owning games like Call of Duty, you've got Overwatch, you've got World of Warcraft, you've also got some more classic games which I'm not going to mention, but these games, I really think that Games Workshop has more IP, and therefore in the future I think there is a lot more room for video games growth more board games, obviously, and also expansion into more entertainment, such as films or even TV series. And I don't think this is too far-fetched. It will just require capital investment, and hey, they're a high capital generating business with an incredible moat and almost a monopoly. I completely disagree that people are selling this and probably buying into these value recovery plays, and I've actually bought 8 more shares, which is quite a significant boost, and exactly why my portfolio value is a lot higher, because I depleted my cash position and poured a majority of that money into Games Workshop, because I honestly think this is a very good bargain. Sure, you could argue that, yeah, 4 months ago it was probably lower, but 4 months ago we didn't have the results update that was really strong. Furthermore, they've predicted that, and I've said this last episode, they've predicted that the first half is actually going to be £80 million worth of profit at least, and they're usually quite conservative. Compared to last year, it was only £59 million. I don't think that's going to change too much, and they would have to update their guidance should it be much worse. And this really means that I don't think it is just a pandemic stock, and therefore I don't think the sell-off was that justified, and I think it may take some time for sentiment to return to all-time highs, but that provides that opportunity at which I'm buying in. The share tip of the week is a high risk, high potential reward, huge potential growth stock listed in the FTSE 250. They have a wide range of content both online and in physical media. Albeit they are in some dying industries, but the management are more than aware of this, and what they plan to do is diversify away from these dying industries whilst milking them for the cash that they can bring. They use this money, invest in new industry or new revenue streams, and then use that old existing capital into that and develop their new streams. So this is a business that might not be the same today as it is in 10, 15 years time, but the management has shown some real promise. This is an e-commerce business that has had fantastic revenue and earnings growth, and that has been a change. 4 or 5 years ago, this was a business that was struggling. However, now they are doing very well, and they've rewarded shareholders in this 5-year time period with over 900% returns, which at the moment may be more than what Boohoo has done. Although investors do have some concerns over their diversification, or perhaps diversification, because they are potentially acquiring a lot of different businesses that seemingly do not correlate and are of a lower quality. However, I believe that since the CEO and management have managed to turn this business around, that they have got a strategy for the future that will be a very strong performer. They plan on expanding their content by finding out what their audience is interested in, then creating that content and selling it to that audience, which is why I understand, or why I think I understand, why they acquired Games Workshop, which, yes, this is Future PLC, which was the first top topic of the week. Since they've dropped by 17.65%, I think this could be a good value to buy in, and I'm very tempted, but it would mean that I'd have to sell one of my positions, and if I'm honest, I'm tempted to do that also, but I'm not going to. I think that acquiring Go Compare is much more useful than a lot of investors have seen. This allows them to tap into the interests of this customer base, allow them to build up more products around it and then market the products to them. I think this can provide a lot of potential, give them a new diversified revenue stream and a lot of growth for the future. Furthermore, they've got the chairman of Go Compare, which will be joining the board of Future, and he's shown a lot of promise in the past and made a lot of money from previous companies. Future PLC has an excellent balance sheet with low debt, although this isn't one for dividend investors, as you'd be getting a yield on your money of 0.095%. But I think this will increase quite exponentially over the long term as their top line and bottom line revenue and earnings growth increases. I think this will start to increase at a faster rate than the market, if not significantly faster, and eventually this could be an excellent dividend yield on cost. And since they've had that drop in the last week, I think this could provide a good opportunity to buy. If you're interested in how I built 4 income sources, including revealing my YouTube earnings, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Stay safe.